So back in 2026, this wealthy guy walks into a shop, sells his silver for a total fortune, and walks out without paying a single cent in taxes. Makes you think, right? Because if any of us sold something for a profit, like a stock, a house, or even just an old car, the government would be the first one there, waiting for their cut. That's just how it goes for the rest of us. But this guy, he found the one loophole that the rules barely even touch. Silver. He's not a criminal, and he's definitely not hiding cash in some offshore account. He's just using a gap that's been sitting there in plain sight for years. So over the next few minutes, I'm going to show you exactly how it works, why it's totally legal, and honestly, whether it's something you could pull off too. Now here's the part nobody tells you. On paper, silver is one of the worst taxed things you can own. The IRS doesn't call your silver an investment. It calls it a collectible, the same legal bucket as baseball cards, stamps, and old paintings. And collectibles get their own special tax rate, up to 28% on your profit when you sell. Stocks top out at 20%. So officially, the metal sitting in a safe is taxed harder than Wall Street, which seems fair. Run the numbers on our guy from the shop. Say he bought his silver years ago for $50,000, and today it's worth $150,000. That's 100,000 inches profit, and the IRS's sticker price on that profit is up to $28,000. He paid zero legally. And by the end of this, you'll see exactly which rule made that possible. You need 3 rules from 3 different decades that were never supposed to meet, because the 28% tax has one enormous weakness. Somebody has to know you sold. First rule, 1997. The Taxpayer Relief Act. Congress cuts the top capital gains rate to 20% for the normal stuff. Stocks, funds, the things banks sell. But collectibles stay at 28. Gold and silver got left in the penalty box, right next to the Beanie Babies. Nothing says taxpayer relief, like a carve-out, with your name on it. So that's the rule on the books. Sell silver, owe up to 28%, which raises the only question that actually matters: how would the IRS ever find out? Second rule, 1982. Congress passes a law saying brokers and dealers have to report your sales to the IRS on a form called a 1099. Sell a stock, and your broker files that form before your coffee gets cold. The IRS knows your profit whether you tell them or not. Coin dealers got the same rule with a twist. They only have to report items on a specific list. And that list wasn't written around what people actually buy. It was written around what's deliverable on commodity futures contracts. Brand stamped, 1,000-ounce industrial bars, trader stuff. The American Silver Eagle, the best-selling silver bullion coin on the planet, is not on the list. Sell 1, sell 100, sell a whole monster box. The dealer files nothing. No form. No record. Nobody is told. Here's the detail that should bother you. The Eagle came out in 1986. When the IRS and the coin industry finalized that reporting list a few years later, the Eagle didn't make the cut. The mint has since sold over 500 million ounces of them. And in all those years, nobody has ever added it. Probably just an oversight. Actually, correction. The list did change once. Recently, the IRS clarified it, so that fewer things count. Glad they took another look. Now careful. No paper trail does not mean no tax. Legally, you still owe the 28%. You're just expected to report the sale yourself. Voluntarily, the most heavily armed collection agency on earth is running silver on the honor system. But the actually rich don't even stop there. Honor systems still involve a decision. They use Rule 3, and this is where the mistake was made. Third rule, 1921, the Revenue Act. Congress writes a quiet little provision for inherited property. When you die, everything you own passes to your heirs at its current market value. All the gain that built up during your lifetime for tax purposes, it just evaporates. It's called stepped-up basis, and it was passed as a bookkeeping convenience. Nobody thought it mattered. Watch what it does. Buy silver at $5 an ounce. Watch it climb to 50. Die eventually, on your own schedule. Your kids inherit at 50. If they sell at 50, their taxable profit is 0. Not deferred, not discounted, erased. A lifetime of gains, gone from the tax system entirely legally, automatically. No paperwork tricks required. Remember, the 28% only exists if you sell while you're alive. So the rich simply don't. They hold the metal. They borrow cash against it when they want to spend. and they let the tax bill die with them. Wall Street has a name for the whole maneuver: buy, borrow, die. Turns out the strongest tax strategy in America is a calendar. And now you know our guy from the shop, the silver he sold. His father bought it decades ago, for pocket change. He inherited it this year at today's price. So when he walked into that shop and sold it, his taxable gain was, quite legally, right around zero. The fortune walked out the door. The tax died on the way in. That rule is over 100 years old. It has outlived every tax reform since. By the way, if this all feels a bit abstract, remember that a U.S. senator was caught with actual gold bars stashed around his house. Not a metaphor. Bars. Different video. So let's answer the second question. Why is none of this a crime? Because every piece is just the law working as written. The 28% rate is real, but a rate without reporting is a suggestion. The reporting gap is real, but that's Congress's list. And it's not your job to fix it. And the eraser at death isn't a trick. It's a 100-year-old provision that applies to everyone. In theory, it's just that everyone with enough assets to die holding is a fairly exclusive club. And in case you think Congress simply can't close doors like this, they can. There used to be a fourth tool, the like-kind exchange, where you could swap metal for metal and defer the tax forever. In 2018, Congress shut that door for everything except real estate. So they do renovate this house. They just somehow keep leaving the same window open. 3 rules: 1921, 1982, 1997. Where they overlap, silver becomes the quietest money in America. Try to pause here and figure out how you do it yourself with these 3 tools. Because now, it's easy. Step 1. Don't buy the trader stuff. No 1,000-ounce bars. You buy the common coins, the ones the list forgot. The everyday, most popular on Earth coins. Tragic, really being forced into the good ones. Step 2. When the day comes to sell, the dealer files nothing. Which means the only person on the planet who can tell the IRS about your profit is you, on your honor. Which small print is a real legal obligation, not a vibe. Step 3. The rich person step. Don't sell it all. If you need money, borrow against the metal. Hold it. Let your heirs sell it for you after the gain has been legally wiped to zero. And because every one of those steps is written directly into the rules, you're in the clear assuming. Of course, you do your honor system homework. The rich do, their accountants make sure of it. One warning though, deadpan but serious. Cash over $10,000 leaves a paper trail. Hand it to a business, and they file a form about you. Walk it into a bank or out of one, and the bank files one too. And if you try to dodge those forms by splitting the money into cute little under 10,000 pieces, that's called structuring. It's a federal crime. And unlike everything else in this video, it's one the government is genuinely excellent at catching. The rich don't structure. They don't have to. Congress has seen this hole up close. In 2010, they actually passed a law that would have forced dealers to report basically every transaction over $600, coins included. The loophole was closing. It never got the chance. In April 2011, before the rule ever took effect, Congress repealed it. Overwhelming bipartisan vote. The official reason: too much paperwork. For them, because think about how your income works. Every dollar you earn at a job is reported to the IRS before you ever touch it. Your W-2 shows up on their desk, whether you like it or not. Nobody has ever repealed that paperwork. You are, from the government's point of view, made of glass. The guy from the shop, with the monster box of eagles, they're still waiting for him to mention it. Now, to any normal person walking out of a shop with a fortune that no one will ever tax, that's hiding money. That's the thing we're all told is impossible. There is no functional difference between a briefcase of unreported cash and a stack of untracked silver, except one of them is a felony, and the other one is a Tuesday, because Congress wrote Tuesday into the tax code. And the fix would be embarrassingly simple. 2 lines of legislation. Put every coin on the reporting list and end the eraser at death. Congress actually tried the second one in 2021. The proposal died quietly, because the people who would have to vote on it are, statistically speaking, people with heirs. So the rate stays at 28% for the people polite enough to report themselves. The list stays frozen in the 80s, and the calendar keeps outperforming the stock market. But until somebody fixes it, this is your up-to-date guide on how the rich sell silver without paying taxes.